What's up, folks? Happy Tuesday. Good to see you. If you didn't catch yesterday's episode, I mentioned the group that we're putting together. It's going to run for about 12 weeks about trading tactics, trader psychology, emotional intelligence, all the stuff that we talk about on the show here. And my good friend and business partner, Victor Sprandi, is going to do a lesson or so on day trading and swing trading. So email me at editor@Martin Chronicle if you're interested. So today I want to talk about time stops. Man, the markets are nuts, right? When you think about some of the grains and some of the pre-market moves, you wake up and you see the things up. Granted, the share prices are between $2 and maybe $500. You can see a 1, 2, 3% move before the opening bell, which out here is 6:30, 9:30 Eastern time. And same with like some of the grains, they're up 20, 40, 60 cents, overnight. And so what do you do? How do you handle that? So a couple of things you can do, obviously, is since the underlying instruments like stocks and futures have a delta of 1, you can use, options to take the sting out of that for those of you who are taking risk home overnight. But another thing that you can do as well is like when you put on risk, because the markets move sharply either way, especially if you look at the grains, like look at corn, wheat, look at soybeans. I'm not saying to trade them, but just take a look at some of the size. Like some of the bars are like gigantic. They're $1,000 to $3,000 bars, given the contract size 5,000 bushels. And so how do you, if you're on the wrong side of that trade, how do you mitigate the loss? Well, one of the things that you can do, we talked about Trading Edge yesterday, is to consider using a time stop. Now, when I first read about time stops, it was regarding stocks, equities, and I thought, wow, what a brilliant concept. Because if you look at the math of how trades work out, you have your winning and your losing trades. But the question comes about is like, when do you start to win? When do you lose, right? Because on some level, the easiest trade is when you buy something at 20, you're risking $2, and you get stopped on the same day. There's not a lot of thinking to do on that. Obviously, you can't make a business in becoming an expert at creating tax loss carry forwards, right? It's like, hey, I didn't even have to try. I just put money on. There you go. No more tax problem. I'll take care of that for you. So the point being is you can also do that intraday. If you notice, that the winning trades start to make you money right away, if you put on a trade and it hasn't made you money by the end of the day, you can go back and look at your history of trades, especially your winners, and say, okay, when did these things start to make me money, right? When did I realize the actual win? And I suppose you could do that in the middle of the day too, if you're day trading or swing trading, is you can take a look and say, when you put the trade on, how soon do you start to, show, because you can color code your winners and your losers. I think a lot of the losers turn out to be red, the winners are green, maybe as a default. But if you start losing money right away after you put the trade on, maybe you effectively just offset the trade before you even let it hit your stop. That would be an instance of a time stop. If you have a winning trade as well, you can see, well, how long does it take me to start making money when I add the trade? Because if it doesn't work out in like an hour's time, again, depending on your time frame, you can look back and see on all of your recorded trades and to see how they performed. And you might be able to see some of expected value built in there in Bayes' theorem and say, okay, well, for 80% of the trades that I put on that lost me money, a good chunk of them, 50, 60, 70% of those were flat to slightly down within the first 15 or 30 minutes. So now you can use conditional probabilities. What's the probability, or Bayes' theorem, right? What's the probability of event B given the known probability of event A? So you can do that for winning and losing trades, and that can help you preserve your capital. It could also help you can do it, again, we're talking about time stops, so you can kind of figure out how to preserve your capital, maybe have a better sense of when you can take your winners, right? Because we're talking about having a trading edge and helping you develop your skill. What's your alpha? because it's probably not going to come from identifying, bullish flag patterns or whatever. I know I like to make jokes about it. And maybe for you, it's important to know that stuff. Okay, I get it. I just don't know that how memorizing those types of things really help you. I don't think it helps you develop an edge. And to me, when I hear people sitting around and talking about memorizing chart patterns, to me, it means they don't trust themselves, right? It means they don't trust themselves. Like they have to focus on memorization as opposed to focusing on what they should be focusing on, which is the thrust of all of our work here, is helping you develop instincts, right? Memorizing chart patterns doesn't really help you. You have to trade it. That's how you get instincts, is you have to be in the game and you have to have real risk on. You have to have feel the burn. And enjoy that because you'll learn a lot from it. So I think some of you can use that to improve your trading a lot if you use time stops. Again, the first instance I ever heard of them, they were in the day. For back in the day, as far as it related to trading stocks. And I think the original theory I heard was, if you put a trade on like a Monday and you're not showing a profit by like Tuesday's close, Wednesday's close, just offset the trade. Because after diversification, you need some type of directional momentum, right? To help you, if you're long, you need it to be momentum up. If you're short, you need it to be momentum down. And, at the end of the day, if that doesn't show up, your timing's off. We talked about what makes a trade. It's good luck, right? Bad luck, good timing, bad timing, good analysis, bad analysis. So let's assume you have good analysis. You'd be surprised how many times you'll make money because of good luck and good timing, and lose money because of bad luck and bad timing. So this kind of speaks to the good and bad timing. And if you can eliminate bad timing, you would think that would be at least a starting point to investigate how you can retain more of your capital, right? By exercising a time stop and saying, okay, if I put on a trade long, the instrument can go up, it can go down, it could stay flat. 2 of those 3 instances, I'm not making money. And in one case, I'm losing money. So I really need the thing to go up, and I need to have it to happen fast. And this we're not even talking about adding to winners yet. We're just talking about managing the risk so that you can help preserve your capital. Because again, what you don't lose, you don't have to earn back. You see? So for even intraday stuff, you might find, I can remember when I was investigating shorter term stuff, again, it was a long time ago, I would actually use a stopwatch and say, okay, if I'm going to put this trade on, especially if you investigated things when they were very overbought or very oversold, you can kind of take a scalp, counter trend kind of a trade, right? Which again is kind of risky, so you don't want to use your optimal position size. But when things get washed out and are 2 and 3 standard deviations from the mean, you might be able to capture some money in like a small mean reversion. Or, where else would it happen? You have a really good equity that everybody knows, even your dead grandmother, and they report before the open. The numbers were soft or even in line, sometimes with what was expected, but the name gets smashed during the day and punished because that's the type of environment that we're in. But you notice coming into like the last hour that there's a firmer bid under the market. You can see the thing kind of consolidating. So now you can put it on your radar and say maybe it's going to rally into the close, and the folks who were short all day are going to buy their shares back. So you might be able to ride their coattails a little bit coming into the close. And so if it's very, very oversold, I'm not talking 1 or 2%, I'm talking about 10, 20%, you might be able to, scalp. And when you do the scalping part, this is where you could use a time stop as opposed to sitting there and waiting, right? Just something to chew on. I know a few of you liked the study that I did on holding overnight over the weekend versus trading intraday. Again, there weren't a lot of rules there, but it demonstrated that you made 42 times much more money just following a simple rule without having to do a lot of work. This kind of goes along those lines too. It's just a starting point for you to kind of do your own testing, do your own experimentation to see if it makes any sense for you. So that's what I would investigate if you wanted to, again, use a time stop, because I do think using time stops and being able to see, like we talked about, asymmetric possibilities yesterday, when you start to engage with the market and put risk on and start looking for these things, perhaps even trading some of them, even if they're suspicious, you can likely record your results, record also how you felt, and that can be a starting point for you if you want to get into, understanding where or what neighborhood at least your trading edge might be. Because if you talk to any pro, they might not ask you in person, because it's like asking a woman her age or asking someone how much money they have. But you ought to be able to define for yourself what your trading edge actually is. It's probably not like, well, I have the ability to identify a head and shoulders pattern. That's not a trading edge. So most pros would not commit money to the market unless they know they could affect their edge. You see what I'm saying? So that's a big difference between the pros and the enthusiasts who are trying to figure it out. Again, we help you do that in the training that's coming up. But anyway, that's all I have for you today. Please like and subscribe. I'll be here with Ganja tomorrow, and I'll look forward to seeing you then. Okay, take it easy. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.